Thank you very much. I'm going to try and give you perspective on Botswana's experience, and this is going to very much focus on the practical implementation of a lot of the issues that have just been raised by Tony Venables and, of course, last night by Paul Collier. I've probably got more slides than I can comfortably get through in 10 to 15 minutes, but I'll concentrate on some of the key points, but I might rush through some of the slides. Just in terms of background, I think Botswana is quite well known as a success story. Moved from low to middle income status, very high GDP per capita, is now about $8,000. And this has been on the basis of a mineral-led economy, specifically diamonds. Botswana is the largest producer of diamonds in the world. Has very large deposits, very low-cost mining, and hence the diamond mining industry is extremely profitable. There are very high levels of mineral rents. And dealing with these rents and the profitability has been central to Botswana's success story. The economy is driven by mining. These just give figures over the last decade, about 25% of GDP, nearly 90% of export revenues, and about 40% of government revenues. But despite this high level of dependence, Botswana is often cited as a country that has avoided the resource curse. And what I'm going to talk about is some of the key aspects of natural resource management, economic and financial management. I'll talk about some elements of public finance, how the revenue has been mobilized, how it's been spent. We've heard a lot about how crucial that is, and the way in which resource revenues have been used to accumulate assets. And then I'll finish off with a couple of comments on macroeconomic policy in terms of avoiding Dutch disease. On the public finance side, there have been a number of key principles which have been used by the government. Firstly, mining production has not been nationalized, but instead there are joint ventures between the government and mining companies. On the tax side, the principle has been appropriate the mineral rents for the government. That's the surplus of revenues over cost of production, but leave the investor with a commercial rate of return, including return and compensation for risk. Important public finance principle has been invest all mineral revenues in the accumulation of other assets, whether they be human capital, economic infrastructure, or financial assets. And touching on Tony's point just now, develop downstream processing, but only when economically viable, not for the sake of it. And how's this been implemented? Well, the government has negotiated very hard with the mining companies, and whenever leverage points come up, when mining leases need to be renewed, etc., the government has used that to its advantage. And an important point is that in the negotiations, the government has been very willing to pay for high-level technical expertise to boost its negotiating position. So if the mining company has some very highly paid London lawyers on its side of the table, the government also hires very highly paid London lawyers to have them on its side of the table so it can negotiate from an equal position. The main diamond mining company is called Botswana, and it's 50-50 joint venture between the government and De Beers. And on the revenue side, government gets revenue from four sources. There's a profits tax, which has an interesting but quite simple variable rate income tax formula where the rate varies between 22 and 55%. As the profitability of the mine goes up, the income tax rate goes up. It's all very transparent. It's laid down in the Income Tax Act. It's not negotiable. It means that as there are more windfall revenues, government gets a greater share. There are royalties, which are again laid down in the Mines and Minerals Act. They're non-negotiable, they're prescribed by law, and they vary between 3 and 10%. There's other taxes, and government also receives dividends from its investment, and under the Mines and Minerals Act, government can get up to 15% of the shares in any mining project as a statutory right. It pays for them, it's not free carry. It can negotiate higher shares, of course, but that's purely on a negotiated basis. In terms of how much revenue has come in and what's been spent over the 30 years to 2012, the government received about $55 billion in mineral revenues, very high in relation to GDP, very high percentage of value added. And in particular, to show how well designed the tax system is, it was estimated that this revenue is more than 90% of the mineral rents accruing to the mining industry. And that's been split between investment in physical capital, human capital, and financial assets. Importantly, mineral revenues have not been used to finance recurrent spending, except that in public finance terms in Botswana, spending on health and education, even if it technically falls in the recurrent budget, is defined as investment with regard to use of mineral revenues. But apart from that, mineral revenues have not been used at all to finance recurrent spending. This chart shows the accumulation of mineral revenues and public investment over time. So the thick line at the top is cumulative mineral revenues, and those three segments beneath show spending on education, on health, and on economic and physical infrastructure. And as you can see, that pretty much spending on those assets has followed the accumulation of revenues. Where there's a gap, it means there's financial assets have been accumulated. This shows summary figures. It's in billions of pula, which is the Botswana currency. If you want to convert to dollars, roughly divide by 8. Mineral revenues have totaled 403 billion over 30 years, and total public investment has totaled 424 billion, so actually slightly more than revenues. So some of the investment's actually been financed from the recurrent budget. The interesting thing is how this has been split. Of the 424, just under 180 on education, investment in skills and training, about 60 on health, and about 190 on physical and economic and social infrastructure. So roughly of the mineral revenues, about 55% on human capital and 45% on economic capital. And a relatively small amount at the bottom has been invested in financial assets. If you look at government's net financial assets, as at the end of last year, only about 20 billion pula. So only 5% of mineral revenues have been invested in financial assets. The rest have been accumulated as economic and human capital. What's the policy framework that's enabled that? It's a mixture of rules, laws, and some flexibility. There's an important statutory framework. We have what are called national development plans, which are 6-year plans with a midterm review. They essentially set out broad policy thinking, and importantly, they include all public sector investment projects to take place over that period. That then gets translated to annual budgets. At the annual level, we have a very strong Finance and Audit Act, which makes off-budget spending very, very difficult. We have another act which has statutory limits on public debt, and importantly, parliamentary approval is required for all public sector spending projects and for all government borrowing. So government cannot incur debt or any debt. The terms and conditions of the debt and the amount have to be approved by Parliament. So every time if government borrows from the government of China, a government of China loan bill has to go to Parliament. There's an important non-statutory principle or a fiscal rule. There are a number of them, but the core one is that all mineral revenues must be invested or saved, and it's measured through something called the Sustainable Budget Index, which essentially looks at the ratio of mineral revenues to investment spending. The flexibility can be good, the framework is generally good, but it has some weaknesses. It does depend on very good processes for selecting and implementing and managing public sector investment projects, as Paul Collier said last night. Investing in investing. You've got to deal with public investment to make sure that money is not wasted. And that's quite difficult to maintain. When you've essentially got a soft budget constraint, when you're running budget surpluses every year, it's quite difficult to maintain those strict rules on the selection of public sector investment projects from a political economy point of view. People see lots of money and they want to spend it. So this issue of managing expectations is very important. It also depends on a competent and honest executive, particularly in the Ministry of Finance, and a strong Ministry of Finance which can exert control over spending ministries. If you don't have those things, it's very vulnerable to abuse and inefficiencies. One of the issues, I think, which is a weakness, is that while you have this general principle that all mineral revenues must be invested, there are no rules about how that investment is split across different asset classes. So in terms of your portfolio of investments, how much do you spend on human capital? How much do you spend on physical assets? How much do you accumulate as financial assets? Those tend to be, investment decisions are not taken within a very coherent overall portfolio management framework. And again, going back to the point that Tony was making about investment in financial assets, obviously there's different purposes, stabilization, parking, and intergenerational. I have to say we don't have very clear rules about what the motivation is of the financial asset accumulation. Essentially, it's a residual, and that may not be a good position. This is on management of the financial assets. I'll skip that. So let me just talk briefly about Dutch disease. Has it been avoided? I would say in general, yes, and really through two key elements of macroeconomic policy. One is on the fiscal side. Run budget surpluses, just looking at the annual budgets, most years there have been surpluses, not every year. During the global financial crisis, the diamond mining industry was very, very hard hit. Essentially, there are no exports for about 6 months. So government had to run budget deficits during that period, but in general, there's surpluses. And this key point that the government's been very aware of is keep spending growth within the absorptive capacity of the economy. If you don't do that, you're going to drive up non-tradables prices, and you're definitely going to have a real exchange rate problem. That is absolutely fundamental. You've got to have a Ministry of Finance and Planning that's strong enough to firstly have a good idea of what the absorptive capacity of the economy is and keep spending within that limit. And of course, going back to the allocation of investment, is you've got to invest in relieving those absorptive capacity constraints. Second major element has been exchange rate policy. We've never had a floating exchange rate. It's always been pegged. It's a managed peg to a basket of currencies. And the general principle has been keep the currency undervalued relative to what balance of payments equilibrium would deliver. So relative to where a floating exchange rate would have taken us, the currency has generally been undervalued. The result of that is, of course, you run balance of payment surpluses and you accumulate offshore financial assets. So that's been an important component of exchange rate management. And just to show you on this chart, it's got two lines, and the important one is the brownish one at the bottom, and that's the real effective exchange rate over roughly last 20 years. It's moved around a bit, but you can see in general the real effective exchange rate has been fairly stable, indicating that, at least from that point of view, the Dutch disease exchange rate side of things has been fairly well managed. But the blue line shows the nominal effective exchange rate, and there has been fairly steady depreciation of the nominal exchange rate over time, and that leads to some quite difficult problems from a central bank point of view, managing inflation. Obviously, if you've got a depreciating exchange rate, it tends to be inflationary. You've got to manage liquidity from all the balance of payment surpluses, managing interest rates in a pegged exchange rate environment. It's a difficult job for the central bank. Finally, has Dutch disease been avoided? Well, yes, as I say, to some extent in terms of real exchange rate stability. And if we look here at the growth rates of different broad sectors of the economy, I think this also tells quite an important picture. These are average growth rates over nearly a 20-year period. And you can see on the left that the fastest average annual growth has been the non-mining tradable sector. Now that's an important test of whether Dutch disease has been a problem. If your non-resource tradables are growing fast, that suggests you haven't had a Dutch disease problem. Mining growth very low. Remember, this includes the period of the global financial crisis where we had a very deep recession. Non-tradables have been growing fast, and government has also been growing quite fast. So there are concerns about high level of reliance of the economy on non-tradables and government, which is a sign of Dutch disease. We do have very high unemployment. I must say that's a problem. And competitiveness is still an issue. Last slide, I would say general Botswana has been quite successful in managing many of the challenges of mineral-led growth, dealt very well with mining companies, good tax policy, good spending and investment rules, and balanced macroeconomic policy from a Dutch disease perspective. There's many lessons which I think newly emerging mineral producers could follow, although I would say that some aspects of our policy framework are a bit outdated and need modernization. Botswana now is a very mature mineral producer. We have 40 years of mining production. The diamonds are not quite running out, but the end is in sight. We've probably got 15 to 20 years left of mineral production, and certainly mineral production has peaked, so we're now moving into the mature phase, and that does require some quite major policy changes of moving into a post-mineral era. One thing I would say is that even if you manage mineral revenues well, the population gets used to riding on a minerals boom, and of course the change of mindset that's required when your growth is driven not by resource rents, but by competitiveness, it's a big turnaround needed, and that's the big challenge facing the country now. Thank you very much.